Okay, let's unpack this deep dive. We are jumping back into Benjamin Graham's security analysis. Really practical stuff today.
Yeah, we're looking at how to, spot those undervalued individual stocks, use comparative analysis.
And tackle that big one. Market timing. Always a tricky subject.
Definitely. Now, maybe you joined us before when we touched on investing versus speculating or looked at financial statements.
But even if not, you can jump right in here. You'll still get a lot out of it. We're pulling straight from Graham, giving you a shortcut to some core ideas.
It's true, though. Things have changed since 1940 when the second edition came out. Valuations, PE ratios, they're generally much higher now.
But don't let that throw you off. The basic principles for finding value, for avoiding risk, still incredibly relevant. Success is definitely still possible.
Absolutely. So our mission today is really to equip you with some fundamental strategies from a master to help you navigate things more effectively, applying Graham's ideas practically.
Okay, let's start right at the heart of value investing, finding those undervalued stocks. Graham hits us with a key idea right away.
He does. He says, the risk of paying too high a price is just as great a danger as buying a poor quality security.
That really frames it, doesn't it? It's not just what you buy, but at what price.
It's
Super critical.
foundational, really. And Graham lays out, basically two main paths to find these individual stocks trading below their real value.
Okay, what are they?
One is using comparative analysis, sort of screening companies, comparing them, looking for the outliers.
And the second?
That's the really intensive study of company reports, the financials, the deep dive work we sort of touched on before.
You can really see those two approaches in how famous investors operate. Like Philip Fisher, known more for growth investing.
Right.
He'd apparently screen maybe 250 companies using something like comparative analysis before picking just a few.
Yeah, and then you've got Warren Buffett, who's very much in that second camp,
Hmm.
reads, like 500 pages of reports and things every day.
Wow. So two different methods, but the core idea is the same for both.
Exactly. Find the gap between what a company is actually worth, its intrinsic value, and what the market's saying it's worth right now.
So why do stocks get mispriced like that? What did Graham think causes these gaps?
He pointed to three main things, often psychological or market-driven: exaggeration, oversimplification, and neglect.
Okay, let's dig into that. Where does the market often get things wrong? Maybe start with overvaluation. Where does exaggeration bite?
Well, a classic example Graham gives is how the market reacts to rising dividends. Now, an increased dividend is usually good news, right?
Sure.
But the market can just go wild. The source uses this great example. Say a dividend goes from $5 to $6. Okay, that's a $1 increase.
Right.
But if the stock price jumps $20 on that news, you've essentially just paid up front for 20 years of that extra dollar.
20 years, yeah, that's serious exaggeration, driven by immediate excitement.
Precisely. Another area is mergers and spinoffs. Wall Street loves action, as Graham might say. And both mergers, putting things together, and spinoffs, taking them apart, often create buzz. It seems a bit contradictory, actually.
Yeah, they're opposite moves, but both get hype.
Right. With mergers, you get the 2 plus 2 5 synergy talk, which is exciting, maybe an oversimplification.
Okay.
But Graham says, hey, with spinoffs, think about 5 divided by 2 equals 3. The market might undervalue the part spun off or just misjudge the whole thing. You got to look past the story.
Okay, so that's where optimism can lead to overpaying. What about the flip side? Where does Graham see the market getting too pessimistic, potentially undervaluing companies?
The source mentions a couple of key situations where neglect or maybe oversimplification creates value. One is litigation risk.
Lawsuits.
Yeah, company faces potential lawsuits, investors panic, sell first, ask questions later. But often, if you actually analyze the potential impact, it's way less severe than the market's initial reaction, that big price drop. That gap can be an opportunity.
So fear creates a discount if you can accurately assess the real risk. What's the other one?
Financial difficulties. But here Graham draws a really important line. He advises against buying companies just about to hit trouble. That's speculation.
Right. Trying to catch a falling knife.
Exactly. Instead, he suggests opportunities might pop up in companies that have already gone through the storm, survived, but are still trading at really depressed prices.
Okay, after the worst seems over.
Yes. But even then, extreme caution. The source stresses this. You need diversification because, frankly, a lot of these just won't make it back.
That distinction's vital after the storm, not during. And it really brings us back to Graham's whole philosophy, doesn't it? That focus on protection, on avoiding loss. Maybe even more than maximizing gains, from predicting what's next.
Absolutely. I mean, investing is about the future, but Graham's angle is different. He said the analyst must consider the changes that may occur, but his main task is not to profit from them, but to protect himself against loss.
So pick things that look good now, based on facts, not just hoping they will become good later.
That's the core of it. It's like that $1,000 used car example again. Your main job is making sure it runs, protecting your grand, not betting it'll suddenly become a collector's item.
Yeah, protect the downside first.
Right. And that defensive stance leads Graham to identify specific red flags, warning signs that often signal problems down the road, increasing your risk of loss. Avoiding these is key.
Okay, let's hear them. What signals should make us really worry?
Top of the list. Suspicious accounting. Graham was absolutely clear on this. He basically said you cannot use fancy analysis to make up for dishonest management.
No way around it.
None. The only solution is just avoid them completely. Integrity first.
Makes perfect sense. If the numbers are dodgy, what else matters?
Exactly. Another big one. Signs of a financial crisis actually brewing inside the company. Not just general economic woes, but specific things.
Like what?
Like inventory piling up really fast, not selling. Or weak earnings combined with lots of short-term debt that needs repaying soon. Or just, debt levels shooting up unsustainably.
Concrete things you can spot in the financials. What about outside pressures?
Yeah, new competitors jumping in. This can be really obvious, especially for businesses dealing directly with consumers.
Right.
The source gives this example of investing in Betsson, a Swedish online gambling firm, back in 2012.
Yeah.
Then, just 2 years later, boom, Swedish TV is suddenly full of ads for loads of other online casinos.
So suddenly much more competition.
Yeah, a terrible signal for that investment. Shows how fast external factors can hit you, leading to losses if you're not watching.
That Betsson story is a great illustration. What else is on the red flag list?
Deteriorating management. Buffett likes companies so simple a fool could run them, but most aren't like that. If a company needs good leadership and that quality starts slipping, that's a major risk.
And sometimes companies just hit a wall, growth-wise.
Yep, an earnings ceiling.
Yeah.
Some businesses just can't easily expand beyond a certain point. Maybe the market's only so big, or regulations limit them. If the upside is capped like that,
Then maybe the risk isn't worth it.
right, you might even be better off in something safer, like bonds maybe, which we'll get to later.
Okay.
Anything else, maybe more subtle?
There is one that's easy to overlook. Lots of convertible securities or stock options hanging out there.
How does that hurt?
Well, it seems fine when you invest, but let's say the company does great, stock price goes up.
Yeah.
That's why you invested, right?
Yeah.
But then those convertibles and options get turned into new shares of common stock. That dilutes everyone else's ownership. Your slice of the pie gets smaller even as the pie grows. It eats into your return per share.
Ah, that is subtle.
Yeah.
A potential drag even when things go well? Okay, thanks for that rundown of red flags.
Yeah.
Now let's circle back to the balance sheet and a method Graham is famous for, buying companies below their net current assets, the net nets.
Right, net nets. This strategy looks for companies that are trading super cheap. So cheap, their market price is actually less than what Graham called net current assets.
And how do we calculate that again? You take the company's current assets, the cash, receivables, inventory, the easy-to-access stuff, and you subtract all its liabilities. Not just short-term, but long-term debt too. Everything.
So basically, if they sold off the easy stuff, paid all the bills, there'd be more cash left over than the whole company's market value right now.
That's the idea. It's theoretically buying $1 of liquidation value for, say, 70 cents. In principle, even if they just shut down, liquidated the current assets, paid everyone off, you should get back more than you paid.
Sounds like the ultimate bargain. What's the catch? There's got to be one.
The huge catch is that companies trading that cheaply are almost always in deep trouble. Seriously distressed.
Okay.
They're often losing money, and their value could keep dropping below your purchase price before anything good happens. Plus, management usually doesn't want to liquidate. That means they lose their jobs.
Right, self-preservation kicks in. Their interests might not align with shareholders there. But the source mentions some ways these situations could turn positive.
Yeah, a few scenarios. Maybe operations improve new management, the industry turns around. Or a competitor might buy them out, seeing value there. Or finally, management might just accept reality and decide liquidation is the best option, returning capital.
So there's a path to value, but it relies on unlikely events, carries high risk, and definitely needs diversification.
Yeah.
How often do these net nets actually show up?
They're pretty rare, unless the whole market is in turmoil. Graham saw maybe 20% of industrial firms fit this description during the 1938 bear market.
Wow, that many.
Yeah, but compare that to 2018, data cited in the source, only about 1.5% of companies met the criteria then. These are really opportunities that tend to surface only during severe downturns when fear is high.
Definitely highlights the distress factor. Recession hunting, almost.
Yeah.
Okay,
Yeah.
let's shift gears. Let's talk about something that fascinates, maybe obsesses many investors. Market timing. Can we actually do it consistently?
Well, Grimm and Dodd were, let's say, highly skeptical of any timing that wasn't based on fundamental value, trading just on price charts, not their thing.
Right.
So the source looks at this through a simulation. 5 different investors, 5 strategies, over a long haul, 50 years. And importantly, the timing strategies use fundamental signals, not just price action.
Okay, tell us about this simulation. What's the setup?
Imagine 5 people. Each one saves an extra $10,000 every year, adjusted for inflation, for 50 years straight.
Okay, consistent saving.
And their goal is to invest that $10 each year into the S&P 500. The difference is how and when they put that money to work.
5 investors, same $10 K added annually, but different deployment rules.
Got it.
Who are they and what are the rules?
First up, all in, Anthony. Simplest strategy ever. Invest the full $10 K on January 1st, every single year. No fuss, no timing.
Just puts it in consistently. Discipline.
Exactly. Then, earnings Edward. He tries to time based on valuation. He holds his cash if the S&P 500's average price-to-earnings ratio is above its 10-year average.
So he waits for it to look cheaper relative to earnings.
Right. He only invests when the PE is below average. Similar idea for sales Sophie, but she uses the price-to-sales ratio compared to its 10-year average.
Okay, another valuation metric, but sales-based.
Then Bond Betty. She uses a kind of Graham-inspired comparison. She only buys stocks if the S&P 500's earnings yield, that's the inverse of PE, looks better than the yield on a 10-year U.S. Treasury bond.
Comparing stock return potential to bond returns. Makes sense.
Yep. And finally, 50-50 Francis. He maintains a constant 50% stock, 50% bond allocation, like Graham discussed in The Intelligent Investor. He uses his annual $10 plus rebalancing to keep that 50-50 split. Buys stocks when they dip, sells a bit when they rise, to stay balanced.
Okay, so we have pure consistency versus 4 different timing or allocation methods based on PE, PS, bond yields, or a fixed allocation. 50 years, how did it shake out?
Well, let's walk through the decades quickly. 1969, 1979. Pretty choppy for stocks. Anthony's just consistently adding money, staying in the game.
Steady Eddie. Anthony.
Huh? Right. Then 1979, 1989. The roaring 80s. Big bull market. Everyone did pretty well, sticking to their plans even through things like the 87 crash.
Discipline worked there.
The 1989, 1999. The dot-com boom really takes off. And this is where all in, Anthony, just being fully invested, starts to significantly pull ahead of the others who were sometimes holding cash.
Riding that wave paid off.
Big time. But then, 1999, 2009. Lost decade, dot-com bust, global financial crisis. Ouch.
Yeah, rough period. Graham's quote feels relevant there, saying those prices were rational insults, common sense.
Totally. All the strategies took hits, obviously. But Anthony, because he kept investing right through the lows, actually ended that brutal decade still leading the pack overall.
Wow, even buying at some highs didn't kill the long-term result of consistency.
It seems not. And then 2009, 2019 was the long recovery and bull market we saw after the crisis.
So the final tally. After 50 years, through thick and thin.
All in, Anthony. The simplest strategy won. His average annual return ended up about 1.5% higher than 50-50 Francis, the balance guy, and maybe 0.5% higher than the others trying to time with PE, PS, or yields.
Now, 0.5% or 1.5% a year might not sound like a huge amount.
But compound that over 5 decades. It results in an absolutely massive difference in the final amount of money. Huge.
That's incredible.
The big takeaway from this simulation is just how incredibly hard successful market timing is. Even using these sensible-sounding fundamental rules, it was tough to beat just putting the money in regularly. Anthony's disciplined, consistent approach was remarkably hard to beat.
That simulation really drives the point home. Okay, so let's quickly recap the key takeaways from this deep dive into security analysis.
Finding undervalued stocks. You can use comparative analysis, kind of like screening, or do that deep fundamental homework on company reports.
With comparative analysis, remember it's mostly a screening tool. Look for big, obvious differences, not tiny variations.
And remember Graham's focus. Defense first. Eliminate the weak companies. It's more about avoiding loss based on current facts than just maximizing profit from future predictions.
Right. Protect that capital.
Net stocks, trading below net current assets. They can be real opportunities, but usually only pop up in severe market downturns. They're rare, high risk, need caution, need diversification.
And the big one, market timing. Extremely difficult. History, like in that simulation, suggests consistent, regular investing is very, very tough to outperform over the long run.
Which actually sets us up nicely for our next topic, senior securities. Things like bonds. Now, I know what you might be thinking.
Yeah, yields are so low right now. Is there anything interesting there?
Well, maybe. The source suggests there are actually some interesting exceptions and principles, even in tough environments for bonds, that are worth looking at.
Okay, looking forward to that. So, as you're listening and think about everything we've discussed today, maybe consider the simplicity of all-in Anthony's winning strategy in that 50-year race. Compare that to the complexity, the effort, the uncertainty of trying to time the market or hunt for those super rare, risky nets. What does that contrast tell you about your own approach to investing? Something to mull over.